Hi everybody, and welcome back to video number 8 in chapter 18. And when we left off, we were looking at tax rate reconciliation for PepsiCo. And here is an example. And they go through all the adjustments from the U.S. Tax rate here at 21% and how they actually arrive at their true rate or annual tax rate after the reconciliation. Okay. Now, disclosures of carry forward and allowances. Here, they're disclosing that they have operating loss carry forwards totaling to $28.3 billion as of December 26, 2020 that are being carried forward in a number of foreign and state jurisdictions where they are permitted. I'll let you read the rest of that on your own, but you get the idea. We are disclosing the fact that we are using those carry forwards and allowances. Okay, a summary of the asset liability method. The FASB believes that the asset liability method, which this chapter has covered, is the most consistent method for accounting for income taxes. Bullet point one objective of this approach is to recognize the amount of the taxes payable or refundable for the current year. And bullet point number 2, a second objective is to recognize deferred tax liabilities and the assets for the future tax consequences of events that have been recognized in the financial statements or tax returns. The basic principles of asset liability method are illustrated as follows. Here are our basic principles. Alpha, a current tax liability or asset is recognized for the estimated taxes payable or refundable on the tax return for the current year. A deferred tax, a deferred tax liability or asset is recognized for the estimated future tax effects attributable to temporary differences and carry forwards. Charlie, the measurement or current and deferred tax liabilities and assets is based on provisions of the enacted tax law. The effects of future changes in tax law or rates are not anticipated. And lastly, delta, the measurement of deferred tax assets is reduced, if necessary, by the amount of any tax benefits that, based on available evidence, are not expected to be realized. So if we look at the procedures for computing and reporting deferred income taxes, we can see that here we're going to identify the types and amounts of existing temporary differences and carry forwards. And we will measure here the deferred tax asset for deductible temporary differences and loss carry forwards using the enacted tax rate. And then over here, we'll measure the deferred tax liability for taxable temporary differences using the enacted tax rate. And then we will establish a valuation allowance account if more likely than not that some portion or all of the deferred tax asset will not be realized. So on the balance sheet, we're going to classify deferred taxes as either net non-current deferred tax assets or non-current deferred tax liabilities. On the income statement, we'll report current tax expense or benefit and the deferred tax expense or benefit and the total income tax expense or benefit. Okay. Now, We'll change subject here, and we'll take a look at applying the concepts and procedures of inter-period tax allocation. Here, under Appendix 18 Alpha, we have a comprehensive example of inter-period tax allocation. So for fiscal year 2024, the Allman Company, which began operations at the beginning of 2024, produces various products on a contract basis. Each contract generates a gross profit of $80,000. Some of Allman's contracts provide for the customer to pay on an installment basis. Under these contracts, Allman collects 1/5 of the contract revenue evenly in each of the 4 years. For financial reporting purposes, the company recognizes gross profit in the year of completion, the accrual basis. For tax purposes, Allman recognizes gross profit in the year cash is collected, the installment basis. So, here is an example of that related to Allman's operations for 2024. Number one, in 2024, the company completed 7 contracts that allow for customer to pay on an installment basis. Allman recognized the related gross profit of $560,000, 7 times 80,000, for financial reporting purposes. It reported only $112,000 of gross profit on an installment basis on the 2024 tax return. The company expects future collections on the related installment receivables to result in taxable amounts of $112,000 in each of the next 4 years. Okay, let's take a look at number 2 here. At the beginning of 2024, Allman Company purchased depreciable assets with a cost of $540,000. For financial reporting purposes, Allman depreciates these assets using the straight line method over a 6-year service life. For tax purposes, the assets fall in the 5-year recovery class, and Allman uses the maker's system. So here we show depreciation for financial purposes, totaling $540,000 over 6 years. But for tax purposes, we have accelerated depreciation, shown here, total $540,000, and the differences as shown here. Okay, information related to Allman's operations in 2024, number 3, the company warrants its products for 2 years from the date of completion of a contract. During 2024, the product warranty liability accrued for financial reporting purposes was $200,000, and the amount paid for the satisfaction of warranty liability was $44,000. Allman expects to settle the remaining $156,000 by expenditures of $56,000 in 2025 and $100,000 in 2026. We have some miscellaneous items here. Number 4, in 2024, non-taxable municipal bond interest revenue was $28,000. Number 5, during 2024, non-deductible fines and penalties of $26,000 were paid. Number 6, pre-tax financial information for 2024 amounts to $412,000. Number 7, tax rates enacted before the end of 2024 were 30% for 2024, and for 2025 and later years, 20%. Number 8, the accounting period is the calendar year. And number 9, the company is expected to have taxable income in all future years. Okay, so if we take a look at taxable income and income taxes payable for 2024, you can see we start with our $412,000. We account for permanent differences. Here's our bond, non-taxable bond interest and non-deductible expenses. And then we have temporary differences, the excess of gross profit for the books from the way we account for installments, and excess depreciation per tax, and the excess warranty expense per the books. So our taxable income is $100,000, quite a bit different from our pre-tax financial income of $412,000. We take the enacted rate here of 30%, and that gives us income taxes payable, the current tax expense for 2024 of $30,000. Okay, now we're computing the deferred income tax at the end of 2024. And here we talk about our future taxable income, and I won't go through them individually, but you can see in total the installment sales of $448,000, the depreciation of $18,000, and our warranty costs of a negative $156,000. Those are future taxable amounts. Now, temporary differences, we have our installment sales here of $89,600 deferred tax liability, depreciation of $3,600 for a total of $93,200. And that's because only a single tax rate is involved in all relevant years. These totals can be reconciled by taking $310,000 here times 20% plus this $93,200 here for deferred tax asset $31,200, and our future taxable amounts as shown in this column here. Okay, so if we look at the $31,200 deferred tax asset at the end of 2024, we had beginning 0. So our deferred tax expense benefit, $31,200. The deferred tax liability at the end of 2024, $93,200, 0 at the beginning of the year, so we had $93,200. And you can see that easily from this schedule here. Okay. And so I can now compute my net deferred tax expense of $62,000 by taking the difference between these two items here. And I can compute the total income tax by taking the sum of the current tax expense here of $30,000 plus the deferred tax expense here for $62,000, giving me a total of $92,000 for income tax expense in total for 2024. Okay, classification of the deferred tax amounts. We're going to take a look here at companies required to classify deferred tax assets and liabilities as non-current on the balance sheet. Multiple categories of deferred tax assets are classified into net non-current amounts. And you can see how they do that here. Here's our temporary differences. And some result in a deferred tax asset and some in a deferred tax liability, as we explained in the prior slides. That looks like a good place to stop this video. And when we return, we'll take a look at balance sheet presentation of deferred taxes. Until that time, bye for now.